Welcome. It is 12:30 and I am Tiffany Eisenhower. I'm the principal broker and owner at Freedom Property Management and Sales, and joined by my longtime friend and prior work colleague and bad woman lender. I will watch my P's and Q's today. Angela Gansor.
Thank you. Thank you.
Angela is one of our preferred lenders. She's one of our most favorite members of our extended team here at Freedom. And so having her join us for our second webinar to go a little more in detail about what's going on in the mortgage industry, what she's seeing on a daily basis, and answer questions that you all may have to kind of break down some of those barriers, make sure that you're as knowledgeable and educated as possible.
Thanks. So as Tiffany already said, doesn't leave me much to say. Angela Gansor with Intercoastal Mortgage. We do go way back, but of course we're not that old. So we started really young back in our banking days. Yeah, really young, really young. But we have remained lifelong friends, and I'm excited that we are working so closely again together, and excited to share our insider knowledge with everybody. Hopefully this is a shout out to my crew. Hopefully I don't say too many times if anyone is watching. And we took the same training. We had this discussion the other day, the clicker.
You know what helps, what I found is like when I do my own little videos and I add the caption to it, and then I see how many times I say or this, or I'm like retraining myself, but we all learn for improvement. So
always.
Yeah.
We are human, I promise.
We are. She may seem very, very superhuman with the amount of mothering and wifing and mortgaging that she does, but
yeah, it's a normal day, right?
In our world. So we will get to the topics for today. And today we wanted to go very much into some of the trends that we're seeing in the market. There's a lot of discussion. You'd have to be living under a rock if you weren't aware that mortgage interest rates have more than doubled in the last 12 months. We'll go 12 months. Like we'll give that a little bit of grace. And so what that has required is mortgage lenders and realtors and buyers to be extra creative. There's been new products that have come in the market. There's some new regulations that have recently, dropped. There's some media hype that has arisen here in the last couple of days that Angela's going to touch on as well. So I'm going to go into some of that, but please drop into the comments either on Facebook or on Zoom if you have specific questions that you'd like for us to address. So starting off first, Angela, like what are you seeing today? So today is April 28th.
Yes.
End of April of 2023.
Correct. So again, just real quick, thank you for everybody for joining us today. I'll be real honest, my industry can be very boring. So we're going to try to keep it light and entertaining. Finance and mortgage, a lot of it is blah, blah, blah is what it seems like, but I love it. So maybe that makes me crazy. So anyways, we definitely want to talk about some current mortgage trends. And as Tiffany alluded to, there's a massive, gigantic, choose whichever word you want, elephant in the room that hit the media the other day. Those of us that are in the industry, we've known that this is coming, and it's that word LLPAs. So what does that mean? Does anybody know what that means? If you are not in the industry, you wouldn't know what it means. It's loan level pricing adjustments, and there's a lot of different factors that come into play to calculate those, and those were in place regardless. Okay, so these are not brand new. It's just their tiers and what prices are coming with some of those things. So factors that go into loan level pricing adjusters regardless. It's going to be down payment. It's going to be what is the loan to value on the first mortgage. Should there be a second mortgage or something right behind there? Again, a second mortgage, let's just keep it simple. So then we are going to look at your total loan to value. That is going to potentially play into this as a factor. What's the loan amount? where are we standing loan amount? Is a lower end loan amount? Are we conforming? Are we super conforming? And what does that mean for this area? In the Northern Virginia, DC, Maryland area, we have a little pocket of not quite getting to that jumbo space, whereas some other, stay there for a second. So in Southern Virginia or in parts of Maryland, you are going to go from conforming straight to jumbo. So you don't have that little mid step in between. Credit scores, they're broken up into different tiers. So it doesn't just mean good, bad, excellent credit. There are broken down specific tiers throughout the chart, the massive chart. You also will classify those pricing adjustments on the type of property. Is it a condo? Is it a townhouse? Is it a single family home? Is it your primary residence? Is it your second home? Is it an investment property? All of these factors come into play. What type of loan are you? And then what's your debt to income? Are you in a conforming loan? Are you in an FHA loan, a VA loan? Are you in an ARM? Are you in a fixed? There's so many parameters. And this conversation also parlays into just a rate discussion anyways. I get that a lot. And I know you guys get it from your clients a lot. Well, what's the rate today? It's not a simple answer. I know that
It depends.
There's so many
Yes.
factors. If you could take a peek behind the curtain of what we have to input to generate a rate for a particular borrow, it really is case by case scenario. So I don't ever just want to quote somebody a general rate. And yes, you can Google online. Dr. Google will give you all kinds of answers, and it can lead you down a particular road that can be very misleading. So if you do want to know what actually works for you or what is more pertinent to your specific situation, you're not going to WebMD your symptoms. So don't WebMD your rate. Please call a trusted advisor. Call me. I will walk through any particular scenario to get you a much better gauge of where you're sitting.
That's so important is getting a full picture, and everyone's situation is different. You know, there's no two purchases on my side. There's no two buyer transactions that are the same. There are no two seller transactions that are the same. There are no two properties that we manage that are the same. So there's never going to be any two loans that are the same. So finding out exactly what your situation is and then bringing that down to, well, what does that mean in terms of loan program, loan term, rates, points, all of that. So what I've heard a lot of in the media, and I've heard, a lot of lenders and a lot of realtors chiming in on this past week, is this idea that the media is throwing out that very well qualified individuals with very high credit scores are now going to be penalized with higher interest rates or extra fees in order to help make it more affordable for those that have lower credit scores, higher debt to incomes, less qualified, in order for them to get a mortgage, thereby kind of penalizing the top tier to benefit the bottom tier. So what's the reality with that?
So you're spot on. It is a situation where, yes, do things need to be put in place for more people to become homeowners? Absolutely. It is made extremely hard for people to become first-time home buyers or to have home ownership. So I will not dispute that. However, when you make a concession in one area, it has to come from someplace else. So the way that it is set up currently is that, yes, unfortunately, people that have better credit or larger down payments, if you're buying a single family home versus a condo, that pricing is potentially going to be a little bit higher rate, potentially, or pricing. I know we're touching on paying points. So it's not just like a flat fee per se. Again, maybe I should step back and explain what a point is anyways. I know we were chatting about that this morning. A point is a direct correlation, and it's not always exactly one specific point. We're just going to use that as reference. So 1 point would be 1% of your loan amount. And that payment up front due at closing would directly correlate with permanently buying down your interest rate for that 30-year fixed period, or if you're in an ARM, or a 20-year or 15-year. So it's going to permanently buy it down. The rate will never adjust. It's just an upfront fee. So you're going to see that there are different structures on how those are performed based on your criteria. So there is a chart, if you will, that again, it's going to break down, where's my loan to value? Where's my credit score? And you kind of meet in the middle, and you have to do these additions and deletions to come up with where does the pricing land? Where does that give me the rate? And then are there points associated with it?
goes back to your first point, and that important thing is it's no one size fits all. So, whether you're at the top tier or the bottom tier when it comes to to the qualifiers, or if you're buying your fifth property or you're buying your first property, talking to a mortgage lender to make sure that they fully understand your situation, because you can't just go by what the media is throwing out there. And in all honesty, there's always been extra features, extra benefits for first-time homebuyers. There's grants that are available for first-time homebuyers that are not available for your individuals that are buying your second, third, fourth home.
Correct.
That have 740 credit scores and have very low debt to incomes. So there's always been this opportunity to help. And this is just one more piece on top of that to help to make home ownership more affordable for everybody.
It's true. And there's specific programs that someone else could not qualify for because there are income restrictions typically on these first-time homebuyer programs, which is to help encourage those that aren't at a certain income level to be able to purchase, and they get these benefits. And those that are above that threshold are not able to access those grants, to your point, or these other second trust mortgages that can be coupled with that, specifically through Virginia Housing. So there's a lot of different benefits that are already in place. This one is just seemingly more direct correlation of you're going to take from this section to help support doing something in this section. And it is causing a lot of turmoil in our industry right now. There's other things that the MBA, Mortgage Bankers Association, is fighting too. There's some other things that have been put off that are not implemented as of May 1. And again, we've been trying to work through this since it initially was announced with Freddie Mac and Fannie Mae. It just didn't hit the media the way it did recently because it's starting officially. But the May 1 date is when the loan was delivered to Freddie Mac and Fannie Mae, and that can take months. So we had some investors that were already pricing this in. It's already been happening in our world. So now everyone else is aware of what's happening. And so now we are having these conversations with our agents, with our clients. There's just a lot of moving parts to it. And, we're just kind of rolling with the punches.
And the reality is unless you have cash to put down, unless you go to a private lender, unless you go to a hard money lender, which has got its own things with it. But, if you're getting a Fannie Freddie loan, there's no way around it. So we've got to just learn how to play in the same sandbox. And hopefully it's nice, clean sand, like I just put in my son's sandbox, and make the most of it that we can. And have good partners with us along the way. So hopefully that helped to provide a little bit of comfort around all of the talk, all the noise that's going on right now in the media. It's always something. It's either interest rates are going through the roof and home prices are falling, or the government is penalizing the rich to benefit the poor. There's always going to be something in the media to get our attention.
Yes.
So listen to it, but then talk with professionals.
And that's just it. You have to do the research. You need to get to the experts. You're going to talk to Tiffany. You're going to talk to someone like me. You definitely want to have that full financial picture discussed with your financial advisor. And that's what's kind of different about us, is that we're going to talk to you not about just this transaction and move on down the road. We want to be your trusted source for any of your financial needs, or your family or your friends. So it's even more important that you have someone that is looking at your picture holistically, your whole financial picture, so that we can dig in and we can make sure that we're keeping you right on the path. I know we started trying to touch on this a little bit, but again, if we joke about this as lenders a lot of the time, but if you're going to go buy a new car, just call me first, please, before, we joke, don't make large purchases during your transaction. But if you're buying a new car, call me first. You could probably do it, but let's just make sure first. If your boss is driving you crazy, you want to quit, call me first. Let's see if you can afford to quit that job. Let's make sure you got another one lined up and it's in the same kind of industry. So we're not saying you can't switch jobs. It's preferred you don't switch jobs. You also, you don't have to call me just for that stuff. Like, oh, well, I have to go buy this or I have to go buy that. If you win the lottery, please call me. One, I just want to know somebody that wins the lottery. And two, maybe you won't be using me to finance your mortgage anymore.
Or you get a raise.
If you got a raise, that's good too. But to your point, especially with these loan level pricing adjusters, if you get a raise, does that put you out of qualifying? Because now you're over an income restriction. So we need to just have that open conversation. We kind of create that circle of trust in that initial conversation. And as long as my clients are open and honest with me, I give the same back. I keep my agents in the loop so that way everybody knows where we're all marching forward.
Excellent. So excellent. So we touched on the LLPAs, the loan level pricing adjustments, and that we're seeing here in the media. Angela mentioned a few industry terms when discussing LLPA. She discussed loan to value, points, debt to income. And this isn't an introduction to mortgage webinar, but it is hard when you're watching this and you don't understand what those terms are. So what do those terms mean, Angela?
So yes, we have our own language. I've been in it a long time and I still am not always sure which one is changing to which acronym. So loan to value, LTV, you'll hear us say it all the time and we say like it's no big deal. Loan to value, that's going to be your sales price or your appraised value versus your loan amount. So that's how we're going to run that calculation. So that's the simple answer there. DTI, debt to income. So we're going to take your gross monthly salary, not what you bring home. We want that gross number. And then we're going to divide that by all of your debts plus the new mortgage payment. And then that's going to spit out our factor from there.
How do you figure out what that debt payment is on like a credit card or a line of credit that might be showing credit?
So thankfully, most times the credit reporting agency spits out the number for us, so we don't have to do the math. In certain instances, if there's an open home equity line of credit, but it's showing that the client doesn't have to pay anything, even though there's a balance, maybe they're in a promo period, so there's no payment shown there. We're going to ask you for your statement to see if that actually gives us a payment, and then we'll utilize that because we have documented proof of what the payment should be. If not, we have a factor that we're required to use. Each investor is a little different. Some of us want to use 1% of the line limit. Others will only have us do a calculation based on how much you have drawn. That brings up another good point that we should talk about just real quick is student loans. I know that's another hot topic as well, and I'm not going down the student loan discussion by any stretch, but when we get the credit reports and there's no payment on the student loan because it's potentially in deferment, we still are required to calculate a payment because at some point, ideally, that student loan is going to come due and repayment will be required. So we want to make sure we're setting you up for success. Plus we're required to calculate it to keep you in there for success, to put in a payment. So Freddie Mac has their own calculation, Fannie Mae has theirs, FHA, VA, they all have their own calculation that we have to plug in there to make sure that we're accounting for that piece of debt. So we're going to count any student loans, we're going to count your credit cards, any overdraft lines of credit that you have with your bank that are showing on your credit report. We will also, any mortgages you already have out there, car loans, those are all different things that are going to be on the credit report that we are going to calculate into that scenario. Plus the new payment that will include your principal and interest, your taxes, your homeowner's insurance, any potential mortgage insurance, and whatever HOA or condo fee is associated with the property. One other thing that I was thinking that I was going to tell you, self-reported utilities. People can do that now. Those we take out of the calculation. We are not required to keep that in there because we wouldn't do that on the new property anyways.
Good, excellent. And the other industry term that you use that is very confusing for a lot of people, and I don't understand it half the time, which is why I have Angela, is points. Points. What are points?
Yes. So we touched on it just a little bit, but again, the easiest math to break it down is 1 point is going to be 1% of your loan amount. And that payment up front due at closing is going to be a direct correlation to the permanent reduction of your interest rate. So let's just say today you could get an interest rate of, I'm totally just guessing these numbers. These are not accurate numbers and not specific to any situation. Let me just put that disclaimer out there. Rates are always subject to change without notice. And I'm not guaranteeing anything right now. So let's just say the rate is 7% today on a 30-year fixed. But if I pay 1 point, then I could buy that rate down to 6%. That's a big change in monthly payment. Now, it is not always a direct correlation like that. It could only get you to 6.5. This is why the points discussion is very important right now, because not always paying points makes sense right now. We're in a slightly higher rate market than we've been. We got really spoiled for a couple of years, much longer than we thought we would have. We are not at the top of that inflation roller coaster. Every time we think we're there, it inches a little higher. Recession will come, but my crystal ball is broken, so I cannot give you the date and time, because if I could do that, I'd have winning lottery numbers. And as much as I love you both, you'd be sitting. So my point to
We
all
will be doing this from like the beach in Cabo.
oh yes,
Not from my office in Manassas while the train is going by.
cocktail in hand. Yes. So sadly, no, we're here, but we're happy to share this information with you. So again, the points discussion is super important because back to the rates in general, it's specific to your scenario. How long do you plan to live in the house? Are you here because you're here for a job for a certain number of years and you work for the government, they're going to transfer you again in 5 to 7 years, and you know that hard and fast. So we want to talk about it because you want to break even. If you're buying your forever home, maybe it makes sense to buy down rates right now, depending on where that payment sits. We want to make sure you break even is the biggest point. So once that recession piece hits in, the rates will drop. Now, will they go to 2 and 3%? Most likely not.
No, we don't have crystal balls, but I can pretty much guarantee you that we are never going to see the 2 and 3% that we saw. We're never going to see those again, unless you're buying down points, unless another COVID situation happens. God, please no. But that's not the reality. And so many realtors, so many buyers, there's a big percentage of our buyer pool that's all that you've known.
Right.
You've only ever known sub 5% interest rates. And that's not realistic. It's not the reality of what the market can endure long term. So having a good, solid conversation with your lender, what your plans are, what interest rate looks to be now, what it would cost you to buy down your points versus what it may cost you in a couple of years to refinance. You know, sometimes the amount that you pay up front in points versus the amount that you could refinance for in a couple of years, it may be better to wait.
Absolutely.
And those are all great conversations to be able to have. But it's not always a one-to-one. It's not always 1 point is 1%.
Correct.
And then 1% is 1 amount. So that question, that calculation always needs to be made with the assistance of your mortgage lender.
And multiple times potentially, because again, we're tied to live markets. The markets, some days they're nice and quiet. Other days they go like this and we're seasick while we're sitting at our desk because we're watching the market go up and down. So it really is a dialed in question. It doesn't always make sense to pay points. And again, you could pay 1/4 of a point and it drops the rate 1/8 of a percent. Is that really moving the needle enough for you to waste that money right now? There's just not a better way to say it. Cash is king. Keeping your cash in your pocket or in your account is still going to be more beneficial than necessarily pouring a ton of money into the transaction up front. The refinance opportunity will present itself, and we want to do that long math problem with you to say, okay, where are you going to break even if you buy down the rate maybe a little bit right now? Maybe you don't buy it down a full point because it's not changing the payment, but $20 a month, maybe if you're lucky. So we want to do all of the calculations and make sure it makes sense. And then say, okay, proactively, if we lock in today at 7, where do we ideally need that rate to be for it to make sense to refinance? We're not just going to refinance you to refinance you. People will do that. But again, you want to make sure that the impact is there because there's a cost to refinance. A lot of people don't know that. They think you just get to change your rate and move on down the road. It's not the case. There's still
you may not have to put it out of pocket because you may roll it back into your loan, but there's still a cost there.
Yes.
So let's kind of go into our next topic that we had, which are some of the trendy programs, the new programs that have come out in the mortgage industry to make it easier for some buyers to navigate this higher interest rate market.
So there's a couple different ways to navigate it, and ironically enough, I guess I am a little older than her. So the programs that are resurrecting now, they seem new to some that maybe didn't know them before, but that's okay. We'll keep the baby face over here. So there's called a rate buy down program. And again, it's not a one size fits all. It's not right for every buyer, but it is right for some buyers. So what the heck is a 2-1, 3-1, 1-1 buy down?
Yes, that's what's been all over, you know, is the 3-1, 2-1 buy down thing. So what does that mean?
So the thing is, first and foremost, you're still going to qualify at what the real rate is. So let's just say the rate is 7%. I know I'm picking on 7% today, but it's easy for math. So 7% is the actual rate, but we can do a buy down. And what that does is in year one of your mortgage payment, your rate with the 2 buy down, so the 3-2-1 buy down. So your rate is going to be 2% less. So that makes it 5%, right? So this is my kid's math. 7 minus 2 is going to be 5 for that first year. Then after that, then the other percent's going to come jumping right in. You're going to be at 6% for year 2. Then we hit year 3, you're going to be at 7% for the rest of the life of your loan unless you refinance. Now, how does that work? That money, it has to be paid by the seller, the builder, and in some instances, it can be paid by the lender. So the buyer cannot buy down the rate. There are a couple of niche programs that potentially will allow that to happen, but 99% of them will not allow the buyer to do it. You'd be better served with a permanent buy down in that instance.
So that means for those of you that may be thinking that that type of a program would work for you, and the situations where a program like that may work for you would be, you know, if you have less than a year or 2 left on a car loan, and once that car loan is paid off, then you'll be in a much better, much more stable financial position to take care of that 7% interest rate, but you need some of that wiggle room. Well, if you're looking to buy a property now, that's not money that you can pay to have the ability for this program. So your realtor needs to know that these programs are available. They need to know the structure of this and incorporate that into the offer that you're making on that home.
Right.
Because the seller's got to be the one that pays that, or talk to your lender about how you can get that out of the lender. And so it's not as easy as just buying points.
It's not, and you really want to go in with that strong financial strategy. You want a good partnership with your lender and your agent, because there has to be a lot of communication on how is that contract going to look when it's being written. How is your agent going to present that to the listing agent and the seller who may know nothing about it, so that they can educate them in the appropriate manner to ensure that your offer isn't put to the side. We want to keep your offer at the top of that stack. We need it to be as aggressive as possible, but it also has to make sense. I've seen a lot of aggressive offers before on properties, and they're put to the bottom of the pile because they just don't make sense. So we want to make sure that you have that true partnership with your lender and your real estate agent and with you, because everybody's working for you, the buyer. You know, we're helping champion you across that finish line to get you into the property that you're trying to buy. So really having that open line of communication is super important.
So true. What other programs, loan programs, are you seeing either resurrect or be creative lately?
So creative on the creative piece, and something that's been around. And again, it's a topic that shows up here and there. It's not needed all the time, but it's a good program to have, is a bridge loan.
I remember bridge loans. We started together at BB&T Bank, and we won't say how long ago, 2002. 2002 is when I started.
Okay.
Well, you were like 99, right?
Yeah.
Okay. That's when I graduated high school. But she had like, say, yeah. Okay, moving on. But back with BB&T, we were doing bridge loans.
A lot of them. And honestly, so I have to say, doing a bridge loan with a bank is completely different than when you're out like in the real big girl mortgage world. I was blown away with the 2 different options. I was like, no, we have to hold deed of trust on both properties. And I was like defiant about it. And they were like, no, you don't. And I'm like, what are you talking about? So BB&T was extremely conservative back in the day. So that's why they were holding notes on both. But anyways, we can do 2 different things. You can do a bridge purchase, or you can do a bridge refinance. So let's just say that you own your home outright potentially, or maybe you just have a teeny tiny mortgage left on it because you've lived there for so long. So we can take equity out of your current home, and you can use that as down payment to purchase the new home. And with doing that, assuming you qualify holding both payments, now you can write a non-contingent offer. So you're not necessarily buying the house in cash. You could, if you've got enough equity here, and what maybe you're buying down. Maybe somebody's lived in a house here in Old Town for years and years and years, and they're tired of the maintenance. They don't want the big house anymore, and they just want a nice, cute little condo and not be bothered with any kind of maintenance. They're probably holding enough equity that they can purchase that property in cash, but they don't want to wait to sell their home first to be able to do that. They don't want to have to wait to move or be hustled out to move and they'd like to just make a smooth transition. So we can take the money out of your house here. You purchase this property in cash. And then once you have sold this property, you pay us off and everybody moves on down the road. You don't have a mortgage. If you, let's just say you have like a $200,000 mortgage on your property here, but you've got plenty of equity, we will lend up to 75% of the appraised value of the house. So let's just say it appraises, and then we're going to skinny off that mortgage because we have to be in the first lien position. So we're basically going to pay that off, and then we'll give you the difference in cash to use as down payment. But again, the biggest leverage there is that now you're not writing a contingent offer. Yeah. So that's much more attractive to a seller because you don't have the requirement to qualify to sell that house. If you don't qualify carrying both payments, we have a bridge purchase loan. So we can also accommodate that where, again, for 6 months, we'll let you roll because we know that house is going to sell. I mean, we are very fortunate to live in a market where we're desperate for inventory. So your house is going to sell.
Especially here in Northern Virginia, which is where Freedom is located, where Angela is located, is Manassas is in Prince William County. It's a part of Northern Virginia. We're a DC suburb. We're about 45 minutes or so outside of DC. And we are very lucky to live in kind of a bubble here where appreciation has always been the name of the game. There was, of course, a dip back in the 2008 to 2012 timeframe when everything dipped, but we rebounded. And we rebounded so well. And so the values of homes here continue to rise. And the inventory is so low. And it makes complete sense. If you've owned a home in the last couple of years, you have less than maybe a 3% interest rate. Either you bought the home less than 3%, right? Or you refinanced, or I'd say even less than 4%. Okay. And so why would you want to sell that? Right. Why would you want to sell that 4% interest rate? Like, we're never going to see that again.
So they're hanging on. Yeah.
So it doesn't surprise us that there's no inventory in the market right now. And so that means that buyers have to be extra careful to put in the most quality of offer. Right. And an offer that has a contingency of needing to sell your primary residence isn't going to put you at the top of the list right now. And it hasn't put you at the top of the list for years. It's been a very, very strong seller's market. So those bridge loans are fantastic. So if you have a client, or if you are in that situation where you do want to downsize or buy that, that retirement home, make sure that you're talking to your lender about bridge loans, because that's not something that every mortgage lender does. No. And could be the program for you. It's something where you want to talk to somebody who has a toolbox full of tools that we can navigate and make sure that we're putting you in the right program for what your specific needs are. Again, yes, everybody's going to hang on to that 3 or 4% and all that equity as long as they can, but people still have life-changing events that they cannot control. Maybe you're getting transferred for your job. Sometimes there's a divorce and there's no choice. There are different, or you've had another child and your house is just too small and you have to surrender living in the smaller space and you're busting at the seams. You need a bigger home. So there are still needs for people to buy homes, and there's just not enough homes for the number of people. So that's really one of the bigger challenges that we're all facing. So whatever we can do on the mortgage side to be creative for you to win when that one house comes up and there's 50 people lined up for it, we want you at the top of that list. Oh, yes, and that is the reality in a lot of situations. So bridge loans are great if you're still planning on selling that home. Now, what if you don't want to sell that home that has the 3% or 4%, but you need to buy? You want to keep that house as an investment property. You want to lease it out. You want to keep that for a long term because you've got a good interest rate in it. It's in a great Northern Virginia market that's going to continue to appreciate, and your tenants are going to pay down that balance, and you're going to get that long-term wealth. So what do you do in that situation?
What I do is I tell my friends to call because she's the expert. So what you do is you want to maintain that property. You want to continue to build your wealth and your portfolio. And even if it's just one rental property, you're converting them into an income producing asset for you. So why not? To her point, you've already got the lower balance. You've got the equity built in. If you're sitting on a nice low interest rate, it's very easy in this area that the lease agreement that she's going to be able to put in place for you is going to more than cover your expenses. Not only your mortgage payment, I'm talking all the expenses, even maintenance potentially can all be enough that you're still going to cash flow positive on that property. So it's definitely worth maintaining. And then you can allow, if you don't want to be the landlord for it, you let her come in and she's going to be the expert. She's going to scrub the clients for you, make sure that you have the appropriate renter in there that's a good fit for your home. That would be my first phone call for sure.
So when you're working with that, let's say I've sent someone to you that they want us to manage their property once they find a home to purchase. And how do you function with that debt to income situation?
So it depends. A lot of people can qualify and they can carry both payments. So then we kind of just let it go there. We're not going to make the client provide us any more documentation than necessary. But if it's close or we need the rental income to qualify, but they've never rented before, we'll do a couple of things. We'll get a rent roll schedule on the property itself, potentially, not always. And then we're going to get a lease agreement from you. And we typically want to see the lease agreement itself for at least 12 months. We don't necessarily want a month to month out of the gate because you don't have the history per se of being holding a rental property. So we want that at least 12-month lease. And we probably want to see the security deposit or first month's rental payment received by you. And then in that, we're going to take, if it's a fresh lease, we're going to take that lease amount. We're going to use 75% of that to offset your monthly mortgage expense, your housing expense, because we're going to still include an HOA or condo fee in that calculation. And assuming you are meeting all the requirements, then we move forward. We'll tell you what you qualify for in that range.
So for those of you that need to hear that again, you do not have to sell your house to buy a new house.
Correct.
But if you are low on, or I should say high on the debt to income scale, if you don't technically have the income to cover buying your new and carrying the mortgage on your existing, you need to reach out to your property manager sooner than later. You need to have that relationship. You need to have that in place. You need to start marketing the home well in advance, because before you'll get fully approved for your mortgage to buy your property, you need to have a lease signed.
Right.
So that means that the marketing of that property needs to have happened at least 20 to 30 days prior. So this is, again, where having that toolbox overflowing with resources is the best thing for you and for your agent.
It's for your agent. And again, it all comes back to you. You just want that team that's fully encompassing and supporting you from start to finish. Let us help you do all that heavy lifting. Just engage us and know that you've got a good partnership here trying to get you across that finish line or get you into that next home that you're looking to purchase.
So true. So we are coming up on the end. I know, right? We've had a couple of questions that I've seen pop through.
Okay.
One question that I saw is, can you do a bridge loan on investment?
We can't, but we can sometimes do it on a second home. So I want to make more details on that. It is potentially possible, but yes, we won't do it on an investment.
Okay.
Now, that being said, you could do a different form potentially of a cash out refinance, but again, we want to make sure it makes sense. If it's used to be short-term financing, again, let's just have that conversation and see what actually makes sense. But you could potentially look at just doing a cash out refinance on that property. But let's look at all options.
And keeping in mind in a situation like that, if you're selling an investment property, then you need to look at the long-term, the capital gain situation.
Correct.
So you need to have a conversation with your investment advisor first to see if selling that investment property, number one, is the right move for you. And number two, do you need to do it in a 1031 exchange situation so that you're not taxed on that appreciated value and the income and all of that. And so it's another one of those, it depends situations. So Joe, hope that answers your question.
Yes.
And I want to look at I think we answered all the other questions I saw from us.
Okay.
What's coming? What's the forecast? What is your very blurry crystal ball?
What is it you?
What's the Intercoastal Mortgage, mortgage team seeing coming down the pike?
So we're hopeful. I mean, there again, we joke about it, but that inflation roller coaster, you're at the tippy top. We joke the whole, marry the house, date the rate. There's all the things around the office, because don't sit on the sidelines and not buy something because you're seemingly intimidated or discouraged is probably the better word of the interest rates. Don't let it stop you. The refinance opportunity will present itself.
Well, and while you're waiting for rates to go down, the price of that home
Is increasing.
is increasing. Just in Northern Virginia on the, I believe this was the Virginia Realtors numbers as of the end of February. It was a 10% year-over-year increase in the average home sale in Northern Virginia.
Yeah.
10% year-over-year between 2022 to 2023. And in that time frame, mortgage interest rates almost doubled,
Right.
more than doubled.
More than, yeah.
So mortgage interest rates are doubling while home prices are increasing by 10%. So forget about the interest rate. That may impact the total price of home that you can buy because of your income, because unfortunately incomes have not kept up with inflation, but get in the game.
Yeah, you have to jump in, because if you don't, then if you're continuing to sit on the sidelines, so is everyone else that's feeling the same way as you are. And the second those rates drop, then everybody's going to come and the floodgates are going to bust open, and you're still going to end up in the same situation. So it's smarter now to see what you do qualify for, get in the game. Then that way you're already one step ahead. And then all you have to do is refinance later. All you do is refinance, and we save you the money, and you don't have to go anywhere. You don't have to do anything, but you don't want to wait until the masses come back out again, because again, we're still up against that inventory, the lack of inventory. So you want to mitigate that risk. And again, you could have already had that 10% increase in equity. I mean, it's huge, guys, it's huge. So you don't want to remain hesitant. Again, have the conversation with us. Let us see where we can navigate you, at least get in the game, and then maybe you can sell because you appreciate it, and then you can go get the house you really, really want. It's just getting in there. I know we said it before, will we ever see 2 and 3%? I don't think so. Are we going to see the 18% of the 80s? I don't think so. Anytime your rate starts with a 4 or 5, I feel like you're winning for sure. But 6 and 7% is not the end of the world. It really is. And I know it feels like we were super, super spoiled.
I bought my first house in 2002 at maybe, I think it was the high 6s.
I was going to say probably high 6s or in the 7s barely. Yeah. So to get down into the 5s, you probably thought you won the lottery.
Okay. Well, no, I sold that house. I kick myself every day for having sold that condo in Braemar.
Yeah.
That's probably like triple the price now.
Hashtag like less. If we can only go back. Yes, yes.
So all these 21-year-olds out there, buy a house and don't sell it.
Hold it. Hold it. She'll rent it for you when you go buy your other house. So again, the crystal ball is broken. Can I give you a date and time when those interest rates will come back down? I can't. I'm just going to be completely honest with you. It will come. Hang in there. We'll get back. But again, we'll never. And I don't know my lifetime. I think we'll see that again. But never say never. I mean, I didn't think we would have ever seen that before. So
true. Well, thank you all for joining us. We are going to continue a monthly chat with Angela, continue a monthly chat on with the Intercoastal Mortgage with the Mya team, and hopefully that helps to provide you with some more education, some confidence to get in the market to buy that house. If you have any questions, you're going to find all of Angela's information in the comments. We will reshare this on our Facebook page as well, and you'll see it plastered all over social. So you can reach out to us in a variety of different ways. Any final parting words?
like I said, please don't be discouraged. Give me a call. Let's walk through your specific scenario so that we can dispel any misnomers or, bad juju that's out there that the media is spouting off. It's enough to make everybody crazy, and just give us a call. We'd really love the opportunity. We welcome the opportunity to go over your specific scenario. We really do want to be your financial partner, and I can't thank you enough for being such an amazing business partner and the opportunity to do this to help educate everybody, because I don't think there's enough of it.
Agreed. Well, thank you all again for joining us. Again, I'm Tiffany Eisenhower, and I'm the principal broker and owner at Freedom Property Management and Sales. We assist individual landlords and small investors to reduce the hassle that they deal with on a daily basis and increase their end of day financial performance of their investment property by letting us take over all of the minuscule tasks, from marketing to finding a tenant, to rent collection, to maintenance of the property, and sometimes even disposing of that investment property and finding a new one. So we hope that you will reach out if you have any questions. Thank you again for listening in, and we will see you next time.
Have a great weekend.
Bye.